In this video, I'm going to give you a very quick overview of some of the things that you might be able to pick out doing ratio analysis for your particular company. Now, we're going to continue using Krogers and Tiffany's for our example here because the companies are so different that making comparisons allows us to see how the ratios would predict some of those differences. All right, I'm going to go, and I'm still using the worksheet that's available up there, the workbook that the Kroger and Tiffany's workbook. We already did the common size income statement and balance sheet, and those are two forms of ratios, but we have a whole lot more ratios shown in Chapter 4 of your book. Let's start out with the current ratio, because that's what everybody starts with. The current ratio is defined as current assets divided by current liabilities. Current assets are the things turning into a dollar within the next year. Current liabilities are things that you're going to have to pay out as a dollar during the next year. A lot of people interpret this liquidity as the ability of a company to pay its current liabilities out of current assets, and that's kind of misleading because it depends on the type of company. What we can see here is that the Kroger's current ratio is less than 1 for each of these years. If I flip back to the statement and look up the current assets, Kroger's current assets are lower than its current liabilities. And if we look at the makeup of it, their current liabilities, accounts payable, short-term debt, and then this other. And I don't know what the other is, but that's pretty high to be an other, and I would want to go research that if I was doing evaluation on Kroger's for real. I'd be going to look into their 10K form and try and find out why that number is so high. Their current assets are fairly low relative to total assets, but remember what we've seen over here in Tiffanys. In Tiffanys, a big chunk of their total assets is inventory. In fact, they hold a lot of inventory, and they hold relatively low amounts of current liabilities. And that's why their current ratio would be so much higher than Kroger's. Some of this is related to the other ratios. We see down here a days of inventory. Now, in theory, days of inventory is how long it would take if the firm didn't replace any of the inventories it sold, how long to empty the store. And we see that the inventory, there's about 26 days worth of inventory here in Kroger's store. Now compare that to Tiffany's. They have on average over 500 days worth of jewelry and stuff. Well, that's because they don't sell it very often. So when Tiffany's buys a lot of inventory and leaves it on the shelf, it doesn't go bad. So having a high level of inventory, that's just the way their business operates. With Kroger, though, it's a grocery store. You can't keep bread and milk on the shelf for 500 days. It'd go bad. So some of their canned goods and stuff can last a little while, but all of it's got a use-by date. So we expect Kroger to turn over their inventory fairly often. The inventory turnover is essentially the reciprocal of the days of inventory. It tells you either per dollar of sales how often you sell the stuff. They sell their inventory on average 17 times during the year. Tiffany's doesn't sell their inventory very much during the year. They don't turn it over very often at all. All right, so those are showing us similar information. We talked a little bit in one of the other videos about the debt ratio. That's the total liabilities to total assets. Assets are funded with either liabilities or equity. For Kroger, most of their assets are funded with liabilities. We looked at total assets. The total liabilities are about $24 billion and total equity about $5 billion. So the $29 billion in assets is mostly funded with liabilities, and that's what that ratio is showing you. Now, Kroger's in the grocery store business. Nobody's really all that worried about them people stopping their grocery buying habits. So Kroger can afford to take on more debt than a Tiffanys. When the economy goes bad, people stop buying diamond rings or gold encrusted watches. And so Tiffanys can't afford to take on as much risk in financing their business because you got to pay the interest on your debts regardless of whether you're making any sales or not. If we go down here and look quickly at gross profit margin, Krogers is in a commodity business. They can't mark up their prices very high, so they only earn gross profit about 20 cents on the dollar, and it's 3 times that for Tiffanys. The operating profit is lower, much lower for Krogers, much higher for Tiffanys. And then the bottom line net profit, that's the revenue minus all the expenses, about 1.5% for Kroger, whereas Tiffanys is up closer to 10%. If we take this a step further and look at DuPont analysis, there's a separate there's a separate video for that. But you can see that what Kroger's actually does, they don't make much when they make a sale, but they make so many more sales than the Tiffanys people do. And they can also leverage up their returns to the shareholders by using a lot of debt. All right, more of that you can read through the textbook to get more detailed explanation. But that's it in a nutshell.